In December of 2021, the Department of Labor warned that private equity was likely unsuitable for your 401k. In 2022, regulators told employers to use extreme care before adding crypto to retirement plans. In May of 2025, both of those guardrails were quietly removed. And on August 7th of last year, Trump signed Executive Order 14330, opening $13.8 trillion in American retirement savings to private equity, private credit, real estate, and digital assets. The New York Times warned this is good for private equity and not good for our retirement accounts. For the majority of 401k holders, this shift will quietly inflate fees and hide risk inside funds that look safe on the surface. For a small fraction of investors who are paying attention, there is still time to get out of the way. We're going to walk through exactly what changed, why it's actually dangerous, and the specific moves you can make this week to protect yourself. On March 30th of this year, the Department of Labor issued a proposed rule called fiduciary duties in selecting designated investment alternatives. In other words, this is the legal scaffolding that lets your employer dump alternative assets into your 401k menu without getting sued. The public comment period closes on June 1st, and the rule is expected to be finalized by the end of 2026. You see, the reason employers have been hesitant is that workers have repeatedly sued plan sponsors over high-fee investments. Nearly 70 ERISA class action suits were filed in just the first quarter of 2026 alone. The new safe harbor is designed to make those lawsuits much harder to win. The DOL described this as a way to unlock the full potential of $13.8 trillion in retirement assets. What's actually being unlocked is access to that capital for an industry that desperately needs new buyers. Take private equity, for example. The standard fee structure is what's known as 2 and 20. 2% of assets every single year plus 20% of any profits. Compare that to Vanguard's S&P 500 ETF at 0.03%. On a $100,000 balance, that's $30 a year versus $2,000 a year before any performance share is taken. Now, the pitch is that private equity delivers higher returns to compensate for those fees. The data tells a very different story. According to MSCI, US private equity returned 5.8% annualized between 2022 and the third quarter of 2025. The S&P 500 returned 11.6% over the same window. In other words, retail investors are being offered an asset class that underperformed a basic index fund by nearly 2x at a fee structure roughly 70 times higher. Morningstar estimates a private equity fund would need 4 percentage points of excess return above the S&P 500 just to break even with an index fund after fees. And here is what's structurally different this time. The institutional investors who have lived inside private equity for decades, pension funds and university endowments, are pulling back. New York City's own pension system has been actively selling private equity stakes due to poor returns and liquidity issues. The same assets being sold by sophisticated buyers are now being routed toward 156 million American workers through their 401k menus. Critics call this exit liquidity. We think that's exactly what it is. And the delivery mechanism is target date funds, which now hold $4.8 trillion in assets. That is where private equity, private credit, and crypto are most likely to be embedded, inside the one fund that most workers never look inside of. Now, this is not a moment to panic and stop contributing to your 401k. The employer match is still free money. But for 90% of investors, the default behavior of leaving everything in a target date fund and never checking the holdings is about to become significantly more expensive. There are 3 concrete moves to make this week. First, log into your 401k portal at Fidelity, Vanguard, Schwab, or Empower. Pull up your fund holdings and look for the words alternative investments, private equity, private credit, or digital assets. Check every expense ratio. Anything above 0.5% is a red flag. Anything above 1% is a screaming red flag. Second, if your plan offers a low-cost S&P 500 or total market index fund, and most still do, that is typically the safest, lowest fee option on the menu. The average mutual fund inside a 401k charges 0.29%. The index alternative is often a tenth of that. Third, contribute up to your employer match, then redirect additional savings to a Roth IRA at Fidelity or Vanguard, where you have full control over what you actually own. Old 401ks from previous employers can be rolled into that same Roth IRA for the same reason. The bottom line is simple. Executive Order 14330 is not going to ruin your 401k overnight. What it's going to do is slowly pack fees and illiquid assets into the funds that look safest on the surface. The people who check their statements twice a year and pick the lowest cost index option available will retire significantly ahead of the people who don't. Set the reminder, pull up the portal, make the switch. Thank you for watching.